people out on Amazon. It
And
is
rely.
scathing part of it. Scathing.
So welcome everybody to the Sofi Weekly. We were just talking about Amazon backstage. Tanner is not here. We have kicked him off the show. He is no longer a part of the Sofi Weekly.
He was too
Kicked
late.
Tanner off and brought me back.
Exactly. So it was a
He'll be
trade-off.
back.
It was a trade-off, how I see it. All right, do we want to just talk about Amazon real quick?
Yeah, real quick as people are getting here. Yeah.
Go
So
for it,
you
Ryan.
two are both shareholders. I'm not a shareholder. I've been interested in Amazon for several years now. I think it's a very good play. It's either been a time of not having money lined up when I think it's a buy, or there's other things that are more attractive to me. Amazon's one that I'm following a little bit more closely. Tevis told me during Bootleg on Tuesday, he said he was buying Amazon for the first time, correct? Okay.
Yeah. I think I bought like 4K or something. It was a small position, but it's a starter position.
And this was before earnings, and I said, "Hey, that's great, great company, and long term and that's for Tevis. Like he doesn't need the money right now. He's filthy rich or whatever, But in single, you don't know. Like,
I'm so sorry to any Amazon shareholder because they just got the kiss of death from Tevis buying it. It was QQQ a couple of weeks ago, and now it's Amazon.
I was looking at the chart. I was looking at the way the market was reacting. That the market seemed to me to be in the mood for looking for an excuse to sell on earnings for many of these companies. And I'm like, hey, a company as big as Amazon, they're going to find something. They'll nitpick, and I hope it'll be nitpicky. And then that thing will drop probably to around 160. And that's not bad. Occasionally I get things right. It's looking pretty attractive to me. I think that, given the macro, it might drop a little bit further. But looking over earnings, they missed advertising a little bit. And there were, there's a little bit of concern for consumer softening. A lot of the reason for the drop is just when they reported that in this week, there's some really tough macro stuff going on right now. But I don't know. It's looking pretty attractive to me. What do you guys think about Amazon earnings and Amazon this week before we get into SoFi?
I'm happy, man. I'm buying more. I'm going to be buying more. I haven't bought anything yet. I just found out the market was red like at 3 p.m. because everybody was like losing their minds over it. And then I checked. I was like, every position that I had was up between like 2 and 10%. And Apple was up 2% of all things. So, keeps on winning. But look, I think you're going to put your money in one stock anyways, right? So if everything's down 5 to 10%, who really cares? Like my money's going to get allocated. I'd rather one stock be down 30% than have everything be down like 5%. Like it doesn't, I don't know. I didn't see it as a huge deal. I'm going to be buying more next week, probably more QQQ, probably more Amazon, just as I build out that position. And then now that SoFi is back in the sixes, I'm definitely going to be buying more SoFi. It's ridiculous. What about you, Steve?
I mean, I'm going to come in hot with Amazon, and I think it's ridiculous. So my opinion on this is a bunch of algos got a hold of it. This was high frequency trading yesterday afternoon. People didn't even have time to read past the headline, and they started selling off for two main reasons. The first reason was that Amazon's revenue, and I don't have the number in front of me, came in around 148 billion, and the street was looking for like 148.72 billion. Came in just under where the consensus estimate was. But people seem to not read anything. And that's what annoys me with this, because Amazon in Q1, they guided for 144 to 149 billion of revenue. That's what Amazon guided for. This is Amazon telling you this is where we're going to come in at. The high end was 149. They came in at 148. The consensus estimate, while the analyst community can put whatever number they want for the consensus estimate, but it should really be the midpoint of whatever the range is that a company's coming in with. It shouldn't be so close to the top end, especially when you're talking about a company like Amazon that's giving you a minimum of 144 billion in revenue in 3 months, they're giving you a range. They met that range. And then the street didn't like what the guidance was for Q3. So Amazon guided for Q3 between 154 and 158.5 billion, and the street's midpoint was 158.43. So like they came up with their midpoint before Amazon even gave guidance. And the stock went down 10% yesterday, if not more, after hours. And when I tell you that I'm watching, I'm like, nobody even read the report yet. I haven't even gone through one page of the report, and it was just massive sell-off. Stop losses getting triggered, everything getting triggered. It's very annoying when that happens because it was a great quarter.
Yeah, that's normal though. Is algos are trained and coded to look for certain things, and they can do that much more quickly than the human eye.
I bought at 161.20, I think, this morning. I bought a good amount, so good. And I guess I made the right move because it finished around 167.
Yeah, and I liked it at 160. If the market hadn't done what it did and it gave some really attractive entries, or in my case, I'm going to be selling cash secured puts on Monday for some nice premium on Robinhood a little bit and a lot of Palantir. I was actually not going to do that with Palantir just because it was up so much. I'd be buying Amazon at 160 for sure. It just that was the entry that I was looking for. We might get more, but 160 is not going to be one of those prices I think that you regret long term. So
yeah, it could go down further, but Amazon's the cheapest it's been on a forward PE basis or even a standard PE basis in pretty much its entire history at this point. I mean,
isn't it also like the cheapest out of all of the other comparable stocks, like Apple and Meta and everything else? Like it's the cheapest.
I have a fresh sheet because I wrote an article about Amazon today. It should be out Monday. So these are the numbers as of right now. So these are the numbers.
I got to zoom on that.
You need another zoom on that?
Yeah, just a little bit. There you go.
So, I mean, look, Amazon is trading at 22 times 2026 earnings. That's insane for Amazon. And quite frankly, I think that they deserve a little bit of a higher multiple than Apple.
Yes.
I mean, they got 65% prospective earnings growth going forward over the next 2 fiscal years. Right now on 2024, they're trading at 36.5 times. I mean, this is not an expensive company from where Amazon has traditionally been valued. And it looks very interesting to me, especially when you look at price to free cash flow. They're trading at 33.5 times free cash flow. They've never traded below 50 from what I can remember. And it's very attractive.
All right.
So this isn't my new PayPal. I've been an Amazon shareholder for a long time. And I've been bullish on Amazon for a long time. And Amazon's actually gone up for a long time.
Yeah, you've been in a lot of them for a long time. And like you bought like Facebook back in like 2013 when it went public.
Yeah.
Insane. Okay, I'm just going to pull this down. And then now that people have gotten a chance to join the live stream, shall we talk about our main topics, Sofi?
Yeah.
Steve?
Can we start with price prediction first? Who was closest on that? Because I missed almost everything else.
Okay. I see where you want to go. Let me pull up a tweet for you, Roy. Let me pull up a tweet for you, Roy. So somehow I knew you would be talking about this. Please look at this performance right here. 7,000 off on members, under 10K, 3 million, 2 million, under 10, new product announcement. So you can keep your price prediction. Okay.
And EPS.
You had 1 cent EPS?
Yeah.
There you go.
That was all. Everything else. I mean, products, we were all right around the same too. Just it's 1.5 times, a little bit less. But Yeah, no, they you hit the nail on the head, dude. Like that was pretty incredible, honestly. So, um, all of us were kind of in the same ballpark, and it was better than we all expected. And there are, qualitative things that were not amazing that I didn't like in the tech platform, which we can talk about later. But overall, I thought it was a very good set of numbers. I think you guys thought the quarter was a little bit better than me, Tevis and Tanner. Steve, what did you think as far as the earnings?
Well, I mean, I dropped an article today and said it was a mic drop quarter. So
yeah,
obviously, I think it was freaking great.
Why?
Look, I'm not concerned with the tech platform because the tech platform is going to take the most amount of time to play out. They're in RFPs that don't take a week, that don't take a month, that could take a year or two. These are very long-term catalysts. The bottom line is they came in and generated 597 million in net revenue. They came in and generated 138 million adjusted EBITDA. This was a quadruple beat. Okay. They beat on the high end of net revenue, adjusted EBITDA, and net income. Quadruple beat. And guidance for next quarter is so big. This will be the first quarter we get over 600 million. And we're not just getting over 600 million. The high end is 645. And somehow they just beat high ends like it's their job. And 165 adjusted EBITDA and the margins going up. I mean, this was a mic drop moment for a company that everybody's writing off as a dead company. So I'm pretty impressed with the guidance, and I'm shocked it's down. And I guess people are now worried, recession, delinquencies, et cetera, et cetera. That's going to be the narrative. It's going to go to 550 before it stops, blah, blah, blah. Don't care. Buy and more.
I can tell you 3 reasons why it's down. And of course, beyond the macro. And so one is, again, just the mood that the market was in this week. And it was looking for an excuse to sell. I didn't think it would hit SoFi as much as it did because I didn't see the reaction or the recession stuff that we're going through. But I knew with SoFi that they would find it, and it's self-inflicted just with their guidance, although they did better as far as giving those parameters and also with the lending, although the lending was a nice surprise, I thought. And so with those, I thought that was going to be the factor, is that it was going to go ahead and sell down a little bit. And then, of course, with any recessionary concerns, although I didn't think it was going to be like this big of a deal. Because bears always latch onto something with SoFi. It's a diverse enough company that if they're looking for meat hard enough, they'll find a little bit, even if it's stale and dry, they'll latch onto it. I think that SoFi needed something very surprising in order to get a good positive market reaction. And for us that have been in SoFi, yes, it beat our expectations, and it was very good earnings. I'm not disputing that, but there were no like, wow, this is amazing, I didn't see this coming type moments. And I think that's what the market in this time.
You didn't feel like that off the guidance, though?
No.
I mean, you didn't feel like that was earnings call?
Honestly, man, I think the guidance was my favorite part of this earnings because, like, I made a tweet about this. I said, when they're saying 4 cents, what they really mean is 6 cents. 645 if they come in at 680 million or 675 million, whatever it is, like that's compared to 598.
Think about that. When you got guidance, let's just say they come in near the high end. Let's just say they come in at 645. The Q4 they're going to be guiding for around 675 or so. Yeah. So then you extrapolate that out to next year. You can have a year where you get close to 3 billion in revenue. I mean, I think that's more than what most people thought going into this year they could pull off. And next year, you have an opportunity for the tech platform to shine because it'll be enough time for some of these RFPs that they are playing in. So there's a lot to like here.
Well, so look at, just before we get into that, Roy, that you have up, I'll just throw this up really quickly. I made a tweet essentially saying that it's going to force all analysts to up their price targets. And we just got an analyst from Goldman. This is the price target revisions upward. They had 8 cents for 2024. They moved it up to 11. They doubled their 2025 EPS, and they moved up their 2026 EPS. It's just going to make every analyst look stupid out there, because if you look at what we've already done in terms of EPS, 2 cents, 1 cent, 4 cents guidance, right? That's like analysts what they had for the entire year, right? And so that's if they meet their guidance, which we know they're going to beat their guidance. Every single analyst is going to look absolutely dumb if they don't raise their projections upwards after this massive guidance.
And when you think about what happened today with unemployment, CME Group is already going gangbusters on a 50 bip cut for September. I mean, there is 69% chance that we don't even get a 25 cut. We're going right to 50. So the housing market, whether it happens this year or next year, is going to be a much different housing market than it is this year. And lending on originations from mortgages is going to skyrocket. And that's going to be incremental revenue coming in for SoFi.
Student loans as well.
Student loans as well.
Huge, actually. Like I did a whole post on this maybe a month and a half ago as I was leaving the university I was working for. The student loan interest rates were up so ridiculously. I think the highest I've ever seen. And I know that if you go really far back, then maybe not. But there's fewer players in that market. That's one that I think could grow actually much more rapidly than the housing. Although I prefer the housing. They're just having the collateral of the actual house is nice. But this, if you'll throw this up, Tevis, this is one of those qualitative things that I thought was a nice cherry on top of an already good earnings. And so this is one of those bear arguments. There's a lot of them, but this is probably the most persistent. It's talking about their lending segment. And so specifically as far as loan vintages and what's fair value and what's not, and their loss rate or what they expect to be their loss rate. They've spent some time in previous earnings, at least the last couple before this one, addressing this and in comments in conferences, even with Jim Cramer. But they, I don't know. Some people are kind of slow. Some of the bears on SoFi are, although they're winning right now. And so just they had this slide and also the next slide as well that they talked about basically the impossibility of having above the 8% cumulative life of loan losses. And of course, the curve, they did a great job in the comments as well, talking with the analysts. Like the call itself was the best one that I've listened to. Out of like the last, I think I've listened like 7 or 8 on SoFi. And so I was very, very well impressed. I love that they did this. And it's one of those things where, I don't know, like bears will probably ignore it and say, hey, it's all wrong and it's going to zero. The other thing I really like too with lending, and I think that's what the market seems to be most focused on for SoFi, although that's completely the wrong approach, is they gave very clear parameters of when they would look to start accelerating lending. They talked about the capabilities, what they can push out as well. And I really liked hearing that. Plus, I liked seeing them open up that loan book just a little bit in Q2. That was a nice surprise.
Yeah, I mean, the more information that they show, the more slides that they provide, the better it is for us. I think the next step, which is what we've been asking for on this show for quite a while, is more information on the tech platform, because it gives us something to, sink our teeth in for what we can expect, what those cohorts look like, what is the distribution between, the fintech versus the financial versus non-financial clients. But at the same time, with the tech platform, which was, I don't think arguably, I think it's a fact that it was their weakest segment that came in, or the weakest part of the call. That is now their smallest business segment, right? Like financial services did 176 million. The lending platform is like double that. And so the tech platform didn't even break 100 million, right? So, I think that bears will say that, oh, well, see, we told you it's just the bank. And the bulls, I mean, like what I was saying was that it doesn't really matter in the short term, because the AWS of fintech thesis is really a long-term thesis. It's not something that's going to get proven out this quarter or next quarter.
So share my screen real quick. This is revenue and contribution profit from their sectors. I threw it in the article that I released today. Or that's
you got to zoom on that.
I don't know if I can. Can I? Oh, I guess I can. So
yeah, there you go.
Financial services was losing money for quite some time, and now it's generating capital, and the growth rate on this is great. And it doesn't seem like this is going to stop. The tech platform, I think, is a long-term thing, and there's other aspects that SoFi can get into to drive future profitability. There's one other chart, and then you look at the originations. I mean, personal lending is still huge. It's still driving everything. Student loans are nowhere near where they used to be, and homes, that's still stuck in the rudders. I mean, next year could look very different, where student loans gets back to around 1.5 to 2 billion in originations, and you could actually see loans crack a billion, maybe get to 1.5. So it'll be interesting. But I do think that there's a lot of catalysts. Look, if you're a long-term investor, I've said this before, I would like to see SoFi get into business lending, business accounts, and asset management and stewardship of 403b, 401k, and SEP IRA plans, because that will give them a complete trifecta into the business segment. It will allow them to collect an asset management fee on AUM, in addition to building out their own mutual fund and ETFs, which they have, and putting customers in those and generating a management fee on that. So there's a lot of synergies by getting into the business side. And then it's also recognition, because if you get, just arguably, a company with 1,000 people and you're doing their retirement plans, Tevis is always laughing, and you're doing their retirement plans, that's 1,000 people that keep seeing the SoFi brand when they log in to their retirement accounts to see where their balance is. And they're going to be not just getting the exposure from that, they're going to be generating revenue on two sides of that. And you could do business lending. You already have the platform set up for personal lending. So there's a lot of things that they can do on the business side and wealth management that I think is really going to put them in a different category.
Yeah, and we'll talk about the credit card piece, I think, second, because that was one of the products that I'd love to get your thoughts on, Steve. But just wrapping up the earnings thoughts, I think that you mentioned on the personal loan side of things, the lending segment continuing to see growth, I think, is significant, because not only did management guide for it to be down year over year, but they also like analysts were pricing that in, and the stock took quite a hit because of that. They were saying, okay, well, lending, which was the main, bread and butter of this business, is going to be down. And now we're finding out that that's actually not the case. Now they said minimum of 95% of 2023 levels, and we know how they like to sandbag. They like to be conservative. Probably lending is going to be flat. I mean, I said this all the way back in January, how I think lending is going to be up single digits year over year, because they're actually going to be much better than they forecasted. And now it's finally materializing for the market to say, oh, wait a minute, lending is growing. What was it, 12%, something like that? And at least on the personal loan side, when rates fall, like student loans doubled in origination, something like that. So I think lending is still going to show strength. Financial services is the thing that's going to surprise everybody. And so in that context, I think for the tech platform to be slower, I'm fine with that.
Tech
Like
platform,
to be something.
It is going to be slower, but we really should be getting a breakout of more stuff than just Galileo accounts. And I think that's something that you guys have hit on in other weeks when I haven't been here. Right. But we really should have more information about their card processing and all those things. Yeah. Interchange rates, what their take is, et cetera, et cetera.
That was my it's why I didn't call it an excellent quarter like you guys did. There's a few smaller things too, but it's largely that. Was it 21 or 22% growth year over year? But it's a weaker comp again. Next quarter they won't have that luxury. Still very much a black box. No Derek White on earnings, and if they don't want to do that, that's fine. Mm-hmm. But like we have no information about what's going on. It's basically them copying and pasting the same comments. And I understand large sell cycle, but having no information on it is like, that's not helpful.
Well, actually, Roy, I think they had fairly easy comps on the tech platform side, because Q1 2023 was when we essentially lost current and we saw a huge decline in members. And then Q2 didn't really it didn't ramp up. So they were going off a much lower base for them to add, an additional 7 million to come at 158. So I think the tech platform didn't have that high bar on it, 20% year over year growth and coming off of really easy comparable period for member additions. One thing I will say though, looking forward to Q3, and I mean, you're going to hear me reiterate this as we get closer, that is going to be a really tough comparable quarter.
Yes.
Because that was the Taylor Swift quarter. Mm-hmm. And so members was 717,000 new additions. And all of a sudden now it's like we have to measure the percentage year over year, Q3 to Q3. So I still think they're going to crush it. I think it's going to be a really big year with a lot of catalysts. But if you look at comparable quarters, this is the toughest one, I would say, just because of how big Taylor Swift was last year.
Yeah, well, it is in member count.
For members,
it was a great Q3. The tech platform is really what concerns me and we don't know if it'll accelerate. Like that's the thing. I think lending will some just because of where guidance is. Financial services will do well, but tech platform, like year over year, might grow at like 12%.
So let me give a little thing about the tech platform. Worst case scenario with tech, it does nothing past what it does right now. Let's just say that's worst case scenario. And that would be not good. Mm-hmm. It still pays for itself. Really, really think about that. So going into 2025, they were generating around $75 to $80 million in cost savings going on a single core and combining all their platforms onto Technesis. The combination of Galileo and Technesis are allowing past 2025 SoFi to save $60 to $70 million a year in costs on hosting all their stuff and everything else. So even if we don't get what we want to see out of tech on the revenue side, eventually those acquisitions will pay for themselves in cost and the cost savings with SoFi. So even the worst case scenario isn't a horrible scenario because you also get the synergies of being able to roll everything out on your own time frame, how you want to do it, and not have to wait for products to hit the roadmap from a third party. So even the worst case scenario isn't a doom and gloom scenario for tech because it gives you all the power you need to do what you need to do, and it saves you money.
Yeah, absolutely. I mean, I think that people are going to be taking it that way. I mean, to Roy's earlier point, right? If you want to find something negative, it's a diverse enough business where you always will be able to. Also, because the tech platform is really the multiple expander of how you view this business, right? Like you don't have a leg to stand on to say this is not a bank if it doesn't have a tech platform.
Right? If the tech platform doesn't come to fruition, this is a financial institution.
Exactly.
There's no question about that. My thesis about a hybrid multiple goes out the window. I'm the first person to say that. For the hybrid multiple to be achieved, the tech platform has to power more than just SoFi.
I was actually wrong. I looked up the numbers because I was second guessing. So here's Q3. Here's the next comp. And it just went up barely from Q2. So actually, we have a weaker comp there. It's Q4 that is really where it jumped a decent bit. And so I think we have a little bit of grace period with Q3. So just to correct for the tech platform. Yeah. Right.
Yeah. If you scroll up and you look at just the Galileo member editions, like it should coincide with the member editions as well.
That I don't care about Galileo member editions, but
no, I mean like it should coincide in terms of how much money they're doing, right?
Mm-hmm. Yeah.
So this is that little dip there is what I was talking about of it having a pretty weak comparable is because, we could have been like, if we never dipped and they came in at 158, then that would be like really brutal. And then if you just go up to the member count, so I can just show the Taylor Swift quarter. So yeah, you see the 717,000 is Q3 of 2023. And that's like the highest member addition number we've ever had. I said it at the beginning of the year, basically, that when we because I was doing the recap for Q2 and I looked at my recap for Q1 and I basically said, I don't think we'll ever see a 5 handle again. And now that we saw the 643,000 members for Q2, I genuinely don't think we'll ever see a 5 handle again.
Well, what's interesting is it dipped to 585, and then you got quarter-over-quarter growth in Q1 and Q2, and now at the end of Q3, football season's back.
Football, NBA,
you
right?
could see more quarter-over-quarter growth, and you could get back to 700,000 member quarters by the end of the year.
Yeah, so end of Q3 would be July, August, end of September, right?
September. Yes.
Basketball doesn't really start by then. Like,
No, well, it does not start by then. But you
So
got football in full swing.
when does football end? February?
January is. You got to think regular season. So
I'm just thinking about like when will all of these things overlap? Because Q4 you would have basketball in full swing, you'd have football in full swing, but then in January TGL also starts up.
Yep.
January.
So there's going to be hype around that.
Yep.
Yeah, football season ends in January.
Okay, yeah,
You're never going to get a full overlap, but you're going to get a cycle that works well.
that's crazy, man. And then you have like golf.
TGL is going to be big. I got news for everybody. It's going to be big. And TGL has the ability to really transform golf as a sport.
Yeah, actually, with Q3 though, especially looking at the tech platform comp, I think it'll actually be a really good quarter. It depends what's happening in the macro as far as how things react, but and that's a lot less certain now than it was a week ago. Yeah, that last quarter too will be really good. I actually think that we'll have the highest member growth ever in Q3. So,
Well, so that's what I'm thinking, right? Because like in my predictions, I said they're going to add 1 million members one quarter, and I'm trying to now determine if that's a Q3 or a Q4 thing.
it's 4
Probably
man.
Q4.
Yeah.
Probably Q4, right?
Yeah.
It's fair. Now, one thing that they did announce that was huge is 2 new credit cards. And what they said on the earnings call, Anthony Noto basically said credit cards has the potential to be bigger than this entire SoFi business is today. He said, quote, credit card is new and ramping up. Our credit card business by itself can one day be bigger than SoFi's entire business. We launched 2 new credit cards. We'll be testing them slowly over the next couple of weeks. So there's massive potential there. Credit cards is really small in comparison to their other financial services streams, but they're definitely investing in it heavily.
Yeah, if you throw this up, this shows the 2 products, and so you have the SoFi Everyday Cash Rewards, which is 3% cash back on dining, 2% on grocery stores, 1% on everything else, and then the Essentials card, which is just like a basic card for somebody that doesn't have a very good credit for improving that. So doesn't have any surprising fees or anything like that. So good additions. We'll actually see. This is one of those segments, like Steve was mentioning, that financial services in the past was a drag on earnings. Credit cards and the Invest platform are remaining drags. And credit cards, they've given some attention to as far as their comments the last couple of quarters. I don't know that they'll push this out really quickly and rapidly, but given that they have a lot more members and that they can see a lot of their data, I think that they'll be okay here. So it's hard to be much worse than what they've been for credit cards in the past, to be honest.
So there's really 2 main sort of discussion topics that I want to stoke here because I think this is interesting. Number one is the quality of the cards. So people are basically saying, just credit card communities, the cards aren't that good. Cards are a joke. Like the benefits aren't that good, and we'll get Steve's thoughts on comparison to Robinhood and all that. They did also take a jab at Robinhood in the call. And then the second thing that I want to touch on as a secondary point is this subscription for SoFi Plus. So maybe we can keep that as a third topic and just dive a little bit deeper into the credit cards. Steve, what did you think of the credit card offerings?
I want to see how it plays out. Credit cards worry me a little bit, and it's a great business if you do it right. Look at American Express, Visa, MasterCard. I mean, take Visa, MasterCard out of it because they have a lot of stuff that are with other institutions too, and they're the back end behind it. But look at what Amex has become. I mean, Amex is just an unbelievable company. And I don't expect SoFi credit cards to get to that level. But look, if they do it right, credit cards is a really big thing that can drive new people to SoFi, because you got to think about it. If you're making your payment through the SoFi app or the SoFi website, and you're not just sending a check when the bill comes, because you got to think more and more people are on paperless now. Once again, that's more exposure, getting people into the thing. You're able to push ads to people. You're able to push services to people, show them that you qualify for this. So it's another thing that can potentially really impact exposure, which is very interesting.
So what's the deal with people? So the way that I see credit cards, right? It's a balancing act between really shitty rewards, which is really great for the business, or really amazing rewards, which is a money drag, a money
Yeah,
loser for
I
the
mean, look,
business.
and I was saying it in our group text that I am not signing up for credit cards. I don't want SoFi paying me any rewards because I don't want them paying me. I'd rather that money going into the business because, look, I'd rather have Visa payment. You know what I mean? Like, um, it worries me because if you get too crazy with the rewards and everything, that does become a big cash outlay at some point.
So
So I don't know.
well, the reason why I sort of harp on that point is because I'm just seeing all of the comments flood in of people saying the benefits are not good, of people saying, the cards are mediocre, that they're not really going to try them, or that they're not enticing enough for people to
Yeah, I
switch
mean,
over.
look, go to NerdWallet. Look, if you use Amazon a lot, there
Mhm.
is a credit card that I think gives 4 or 5% back on Amazon purchases.
5, yeah.
And
It's got it.
if you go to NerdWallet and you put in like what you use the most, they'll show you what card. Now, I haven't done that. I have the same card I've had for 20 or 25 years, something like that. It's crazy. But you have a lot of cards that are geared towards certain things, whether you want cash back, travel, cards that give you access to lounges, Amazon. So
Well, so
two percent may not be enough. 3% may not be enough to
this
entice
is
people.
the way I see it, right? Like if I'm doing the devil's advocate argument, on one hand, I can say, okay, well, I'm happy as an investor that the benefits are mediocre because I know that they're not going to lose an arm and a leg on the credit card benefits. On the other hand, I can say, well, if they're not enticing enough to move everybody over, this is not going to be a needle mover for the business.
I agree. I mean, look, how many people are actually just going to sign up for another credit card just to sign up for another credit card?
It has to be very good. I
Like the Robinhood card made sense for a lot of people because the rewards were that good.
still are, yeah. Yeah, that's really my next card. I ended up getting a Alaska Airlines credit card because our old card we've had it a long time. The rewards are just not that great, and we're planning to fly up to Alaska anyway this next year. So that worked out, but we hit that income amount. So ended up this week getting the Amazon credit card just because we spend a lot on Amazon. I'm like,
You did get it, Roy?
oh yeah, I got it.
All
$200,
right, so it is 5%, right?
5%
Okay.
for all Amazon purchases. They have like 3%, I think, on travel and 1% for everything else.
Is this like in partnership with Amazon, like a bank with Amazon partnership? Like, what is this?
It's through Visa, I believe. But I
Throw
don't.
up Knuckles comment. That's hilarious. Oh my God. I'm sorry, Roy. That's just hilarious.
This?
Yes. I love it because Illmatic's arguably one of the greatest albums of all time. So
It's a great album, yeah.
great album.
Like a no skip album. Sorry, go ahead, Roy.
So yeah, that's what we went with, and I'm waiting on the Robinhood card. I don't know why. I see all my friends and everything getting it. I'm like, come on! Like, I've got a decent amount of followers. I've got a pretty good chunk of money in Robinhood. I'm signed up for gold. I hit that wait list saying like early, and it's like they're just dragging that. So Vlad, please, just give it to all the Roys. You'll get me in that. I'd appreciate it. There's like probably 10 of us. So
is that like still a huge thing? I felt like the hype for that gold card, like it was like one news cycle and it died down.
I don't think it's like yeah. People are eagerly awaiting the card. I would say. I know that's one that a lot of people want to have just because the rewards are ridiculous as a consumer. Now, is it good for the business?
Have they reported since they released that card or not yet?
Not yet, but I mean, they have. They mentioned that they had hit, I think, 50,000 people that have activated their gold card. They sent out invitations to another 50. Pardon?
How many credit cards do each of you have?
Is it 3? I got the Amazon one. Yeah, just 3.
Tavis?
Hold on.
Oh, he's got to look. He doesn't even know.
I got no.
Not debit cards, just credit cards.
Yeah. So I got one for.
And I'm not talking about your business, just
okay, my personal.
Personal.
I got an Amex. I don't
want to know which ones. Just how many do you have?
3.
Okay, so each you have 3. I have 1. I'm just wondering, like, does it make you interested in opening up another credit card? Because when I think about mine, I may not have the greatest rewards. In fact, I know I don't have the greatest rewards, but I've never had an issue with my credit card. And the company that I use, to me, that's worth more than anything. I've never had an issue. So I don't know.
I don't know, man. I don't know what maybe people, like normal people, are different, but for me, like maybe I can relate more to the SoFi consumer. Like I have 830 credit score. I have a great job. I have no debt, and I don't really need all of these other credit cards because I'm never going to be churning the rewards. So I'm just going to use one main credit card. And for me, like the Amex is the perfect one for me because it just gives me an all around good benefits. It's good enough for me, right? Like I'm not going to be buying Amazon purchases with my Amazon card and then buying something else like restaurants with the card that prefers restaurants just to like churn a couple extra percentage points. Like I really, it's more hassle than it's worth. I don't know if that's just a me thing or if that's a thing of people in a certain like.
Look, the 5% from Amazon is enticing to me, and that may end up becoming my second credit card because look, we spend a lot of money on Amazon, so it just makes sense not to leave that 5% on the table. So I may have that become my second card and just up to the Amazon account.
And if they do the same thing as they did with me, they just gave us $200 credit as well. So, and there's no annual fee. I really like that. My plan is
I'm never paying anybody an annual fee for a credit card. Get off your high horse, Amex. I'll never have an Amex just because of that.
What about Robinhood Gold?
Steve, you earn it back though. Like I earned my annual fee back.
I'm not paying you for me to spend money on your credit card. No, you're paying me.
It's like paying for Robinhood Gold, man.
I don't travel. I'm not going to any lounges or anything at the airport. It's like I don't need it.
But yeah, Steve, but my point is, if a card with no annual subscription fee or whatever gave you 1% and the annual one gives you 3%, you're better off. You're making more money at the end of the year.
There are definitely cards that give you more than 1% that have no annual fee.
You get my point. It's just an analogy.
So for us, we got the Alaskan Airlines card. It does have an annual fee. It's, I think, $79. It might have been $99. I know they raised it, but I think it was $79. Not very good cash back. It's like 1% or something, but they gave a whole bunch of miles along with that and companion passes. So the rewards with the free ticket actually is basically we're getting 2.5 tickets for free, or for like the annual fee, $79 or $99. We don't plan to carry this card forever. It's going to probably be for 2 years. At most, probably more like 1 year, and then we'll just not use it anymore. We're not going to pay the annual fee repetitively, but that entry bonus was good enough that I'm like 2.5 tickets, $99 twice. Sure.
Do I have a Costco card? I have a Costco membership card. I have a Costco credit card. And yes, I do know how credit works. Thank you very much.
Yeah, I mean, like I would buy a Costco card. I don't have one because I just do the Instacart, and whoever the delivery guy is gets the Costco has a Costco
card. Membership is different than paying a credit card company an annual fee. I'm actually a lot of value out of that Costco membership.
So you would feel the same way with the Robinhood Gold, that you get other value in addition to.
Yeah, I mean, look, if I was willing to move my banking stuff over, Robinhood would make a lot of sense for us, but I'm not.
So, okay, you both have seen the benefits of SoFi's card. It's not going to entice you to open a new credit card. It's not going to entice you to switch over. So are we thinking that this is not as big as the management team thinks it's going to be? Like, who does this appeal to, man? Because like the top FICO, score havers, they have their pick of the litter for whatever credit card benefits. Like, you get emails in your inbox around promotions.
I think the big test, go share your screen, go to NerdWallet, and just start looking at stuff. I mean, look, bottom line is if anybody is actually going to go to NerdWallet and look for stuff that pertains to them, the SoFi credit card is probably not coming in the top 5. No. So if it's not coming in the top 5, I don't know that this is something that makes a whole lot of sense.
The Essentials card might be actually more useful of the two, even though there's not really anything as far as rewards. But somebody with lousy credit that just wants to work on building their credit, and maybe they have a smaller limit.
Now, if that's what they say that the vision is, to get people that are students and younger people and have that be your starter card, that's a different story.
That sounds risky AF to me, though.
It does, but it's a different story. I think there's more people that would be willing to do that than try to line this up on a reward versus reward basis, because it can be pretty hard to compete with the Robinhood Gold or a big Amex card that gives you travel, or the Amazon card. Because look, a lot of people use Amazon. I mean, I get packages delivered to me within 12 hours sometimes. It's really hard for me not to use Amazon a lot of the times. And if I was to get another card, it would be an Amazon card.
Fair. What about the subscription thing, right? I mean, do we want to just move away from the card and talk a little bit about this? So we're basically talking about what other accelerators does SoFi have?
Business.
A business doesn't exist yet, Steve. Like,
it's an accelerator. You need to make it exist. Business is more important than credit cards.
I understand, but we're saying what's on the radar right now.
Business should be on the radar. I'm hoping somebody's listening, because I can't stress that enough. It is so much more important than what they are doing with credit cards. Like, scrap the whole credit card thing and do business.
So maybe just talk a little bit about that, because I'll clip it and I'll post it on X and I'll tag Anthony Noto. How about that? This is your pitch. Go.
How about I'll just write him a business plan and email him?
Why haven't you done that already? What are you writing alpha articles for?
Well, I mean, I emailed him the other day.
Do you want this stock to succeed, Steve?
You know what? I will. I'm going to make a full-blown business plan for it. I'm going to email him, and then I'll send you a screenshot of it. I'm going to white out the end of his email address.
Fair enough. Sure. Sounds good.
But I did email him to congratulate him on the quarter.
You emailed them to congratulate them? Just DM them like the rest of us.
I sent him an email.
That's class right there. I like that.
It's like Dan Dolev every quarter. Great quarter. Did you you may not have caught this, Steve, but PayPal and SoFi were at the same time for earnings, and Dolev from Mizuho asked questions in each, even though it's simultaneous. So I just
wait, seriously?
Yes. I thought I was like, when I was going back through SoFi, I was like, wait a minute, Dolev's asking a question, and then didn't he ask that at PayPal? And I checked him, like, yeah. So I don't know if he has like an intern there or something that's just like, hey, here's maybe the question that you wanted based on these earnings. But that guy's something else.
Yeah, just like two phones on him, on hold.
I guess.
Okay.
I like, as annoyed as we get when our companies have earnings at the same time. Like, imagine being an analyst where it's like,
well, how about this is something that we should say to Noto. How about don't have SoFi earnings the same week as big tech? Like, maybe that's a good idea. Maybe don't have it the same day or the same week as Meta, Amazon, Apple, Microsoft, and a Fed meeting. Just saying. Like, the noise, the message gets drowned out, and people overlook it, and people don't even look at it because there's so much going on. They really should move earnings to a different week when there's less stuff going on.
It would be it might be beneficial if they do it in a week, and banks tend to do it fairly early.
They do it immediately after. They do it immediately after banks. So banks are like the Wednesday, Thursday, Friday, and then SoFi usually does it on the Monday, but this time they just did it on the Tuesday.
They should do it in like the third week of August.
That's when all the like shit stocks go though.
Yeah,
Like,
it'd be the most interesting thing that everybody's talking
Right.
about.
This would fit right in. The company's great, but the stock, no.
It's
fair
just
enough.
there's too much going on. And the news cycle is all about other companies this week. So thank God Noto has a very good relationship with CNBC, or he would never get on.
Yeah.
Yeah. Yeah, I mean, he has Kramer rooting for him. Well, Kramer did ask a great question actually this time around. He was just like, "Why do you think the stock hasn't responded yet to anything that you guys are doing?" And basically, in so many words, Noto was like, "I really think it's a macro issue that people are just waiting for rates, and then when rates start to come down, then that's when we're going to get a response." Which I think is fair to say, especially if we get 50 bips. That's going to be big.
So do we think? See, I would have agreed before this week, but it looks now like the Fed already messed up, which it doesn't shock me. I'm
But we
very
knew that.
skeptical of that. I mean, like we all know, like they're going to be late because they always are freaking late. They should have cut and just small cut, just this week, but they didn't. The next meeting is going to be for the end of September as far as rate cuts. They can have an emergency meeting, but if they do an emergency cut, that's going to be incredibly bearish. If you look at past cuts, that's one of the reasons why a lot of people get confused and they look at cuts and they're like, wow, they're really bearish. They're not. It just depends on why the cuts are happening. And if an emergency cut is happening because the world is falling apart, that's pretty bearish versus coming in September. Yeah, maybe 50 basis points. Do you think if the macro is still very unsettled and looking at a recession, that we get a rate cut of 50 basis points in September, is that putting SoFi as a stock in a good place or not?
Jay Powell says I should have cut in July. I'll consider August.
Well,
So
he should have cut in May. I mean, look, unemployment was at 4.1% before today. Okay. It's up to 4.3%. Every time since 1948 that unemployment has gone up by 1% or more, you have either been in a recession or a recession has immediately followed. People getting laid off and people not having jobs is the worst possible thing for the economy. And Powell and the Fed should be ashamed of themselves because at the end of the day, they have a dual mandate and maximum employment is more important than price stability. It just is. I mean, it's ridiculous. They're always late. And to think that we don't have this data, how many people were screaming this for months? The fact that they are not using real-time data, it's 2024. It is a sin. The whole thing should be overhauled. We can see to the penny the U.S. debt clock and the military-industrial complex budget move to the penny every second of every day. It's all on real time. You're telling me the Fed didn't have access to this information? I'm not buying that. I'm just not buying it.
I need that.
Can I send them an e-fax?
I mean, they probably still use a fax down there.
They probably do. Somebody get me their fax number. I'll write them a business plan also.
Just pay them.
But look, the bottom line is that they messed up again, and this is not good because the carrying cost on debt is more expensive, and you just put it in a position where more companies are laying people off. Intel's cutting 15,000 jobs. More companies are laying off. That's not good. Like, you need lower rates so smaller and medium-sized businesses can actually borrow capital to expand.
Intel and Unity are competing to see which business can be the most inept.
Which one can go to zero faster?
with having like a near monopoly, or if they're a triopoly, in the case of Intel, just. But okay, so Steve, you agree that they're too late, that rate cuts are almost certain to come. I mean, it's priced in September. If the macro continues this way, that it's looking like recession, more unemployment, will those 50 basis points of cuts in September be bullish or bearish for SoFi as a stock?
I don't think they're going to go 50 bips because if they do, they're basically admitting that they were wrong and late. And I don't think they want to admit that. And also, the other reason why they're late is because even if they cut 25 bips on Wednesday, it wouldn't have showed up in this data, so it wouldn't have mattered. They needed to cut in May is when they needed to cut. You didn't have to cut in March. But you should have cut in May. Because you could have set the stage for multiple cuts this year, but they didn't. And now, if they do anything more, after playing the data dependent and the conservative card for so long, if they do 50 bips out of the gate, it's going to look like something is really wrong.
Yeah. Yeah. I think that's going to be heavy handed. Do we think that it's going to be August or September, or like, what do we think? 25, 50?
I don't think that they're going to do an emergency cut in August. That's an even worse message.
That would be the worst mistake that they could do. It's actually better to just let things melt down and just do 50 basis points in September. But it might be 25. Either way.
You're an advocate for the 50 bips.
They're way late right now. They are like 6 months late on cuts. They should have done a very small cut, mostly symbolic, waited a little bit, and another small cut, and then waited a little bit and another small cut. That we'd be already at 50 basis points reduced by now.
I mean, right now, the big problem is they don't have a choice except September, and that's another 50 days away that unemployment's going to keep going up based on the trend.
So, I mean, look, the flip side of this is that this makes Anthony Noto look like a freaking genius because he was, I mean, even recently in the CNBC interview with Jim Cramer and on the earnings call, he basically mentioned we're going to see what the Fed does at the end of this week, but we're remaining conservative. You know, we're looking at the unemployment numbers very carefully, and then we can adjust accordingly for our lending segment depending on what the macro is going to be. So, I mean, this is, I know it sucks for us to have them be so damn conservative and for us to always, you know, add a premium to whatever their sandbags numbers are. But this is the flip side of that situation where if it actually is as bad as they think it's going to be, then we're still covered because they're still going to meet all of that, you know, guidance and then some. So just the counterpoint, right? Like management has a closer look.
I'm okay with them being conservative. I am more, and I have time. Like I don't need the, as much as everybody wants to see this at a different price point, as much as everybody wants to see this go up, I'm looking at it as I have time for this investment to mature. I want the right thing to happen for the U.S. economy and for Americans. Like the Fed is not on Team America at the moment. Like, it's just crazy. I don't understand what they're doing. Unemployment going up is not good. Let the free market sort out. If you're worried about price stability, how about a little bit less regulation? Let the free markets handle it, and you'll have more competition, and prices will work themselves out. I think that they've been too restrictive on this. But lower rates is, when is that for?
You're on mute, Roy.
This is September, so 78% chance.
That can't be.
Of a 500.
I just looked at an hour ago. It was much different.
This is on the CME Group site. Are you using a different?
Yeah, I just looked at it. I think I even still have it up. Hold on. I still have it up. September 18th, I have 69% at 475 to 500.
Refresh.
This was an hour and a half ago. They couldn't have just flopped like that so quickly.
Yeah, I know that 475 to 500 rate doubled today, or doubled on the week. And
hold up. So stop sharing. Let me share this, and then you can go back to yours. This is freaking crazy that they're just flopping all over the place.
Oh yeah, and this is, by the way, you're pulling it up. It's uncertainty in the market, and markets don't like that. They don't.
This is from like an hour and a half ago. I was looking at this before we went live.
It's insane.
That's insanity. Now let me refresh. Yeah, unbelievable.
That's crazy.
That's really weird, actually. I wouldn't have expected that much of a shift in an hour and a half.
Yeah, that's pretty crazy.
Did something happen in an hour and a half? Like we've been on the pod. I don't know.
Oh, I mean, the U.S. is sending carrier strike groups overseas. So.
Didn't Iran say they're going to have a big announcement or something? But they say that every week, though.
I'm not. I don't even know. This is not good. This is not good.
Did you see the thing where I mean, we can talk about this in the after hours. Is there any last thing for SoFi that we want to cover here just before we wrap up the pod?
Yeah.
Oh, actually, hold on. I have something. TJ, thank you for the $5. I promised I'd throw this up. Why doesn't SoFi market their vision of becoming the AWS of fintech more? After all, that's why most are invested, in my opinion.
I
Who wants
agree.
to take it first?
I agree. People forget why they acquired Technesis, why they acquired Galileo, why they built out a single core platform, multi-tenant, and the capabilities. People forget about the cost savings because the only time they talked about was during the Technesis acquisition. They have not talked about it since. And I have to keep going back to that investor deck when I want to cite it. And they really need, I wish they would bring Derek White onto the SoFi earnings calls, give him 3 to 5 minutes and have him really articulate it because it is powerful. And they should be breaking out the different things with Galileo, and they really should explain better. There was a great Noto interview with one of the analysts from Bank of America where he went through everything, but they don't go through it in depth enough on these conference calls. And quite honestly, they really do need to win a big client to give it some real, to give it some oomph behind it.
I mean, a big client that they can actually name drop, that it's like a sexy logo.
Yes.
But I think that the reason why they don't talk about the AWS of fintech enough is because the revenue as a percentage of the total revenue does not justify it. And it's such a long dated target for them to achieve that analysts will give. It's like Tesla talking about the Optimus spot being the biggest driver of their business. Like, that's great, but nobody's going to give you the benefit of the doubt or price that into their models at all, because there's a lot of execution risk that's baked into that. And so once we have everything playing out with lending, once we have everything playing out with financial services and the business is more diversified and they start landing more, big clients, then we can start to talk about hybrid multiples and AWS of fintech, but that's a few years away still.
And we don't have any inkling as far as, we have an idea of as far as a TAM, how big that could be, but yeah, like when that actually starts landing, just be a shot in the dark.
I mean, we know it's going to be several quarters at a very minimum.
They mentioned on the press release, man, they were like, the tech platform we expected to do mid to high teens in terms of the growth. And then they said something on the press release. It was actually like written down, like, keep in mind that this thing, it takes multiple quarters, not months or weeks for us to land these big deals. So people need to pair their expectations, I think, for that.
I mean, I think we've done a pretty good job at saying that these RFPs can take more than a year. Like, this is not a very quick thing.
I mean, look at the flip side, right? B-Dub says it's been several quarters for several quarters, so we talked about, there was evidence that pushed us towards Citi being a big proof of concept back 2 years ago in 2022, and so you're thinking to yourself, okay, well, 2024 is halfway done now. When will some of these big logos come in? When will we see a big jump in the accounts as opposed to a gradual increase?
But keep in mind, SoFi does not control the timeline of another company's RFP.
Yeah, but it would be nice if they at least gave us some clues onto how long.
It would be very much appreciated if they gave us more insight to what's going on.
But we've talked about that before, so no need to beat around, beat a dead horse.
Yeah. But I mean, there's things that they can go after. I think they need a new investment map out. I mean, I really think they need to overhaul some of those things. And to me, business is the big thing they should be going after right now.
Mm-hmm. Okay, so maybe we can end on this. What are you doing with your SoFi position? Are you just holding what you got, looking to add at a certain level, selling covered calls? What are you doing?
I'm buying more, baby.
Yeah, it's in the rotation to get more. I think I add 12 to 14% this year, and to my original position. And I think it's definitely in the rotation. I mean, I added to Alphabet, Amazon, Nvidia, and Intel over the past 2 weeks. So SoFi is definitely in the rotation the next couple of weeks to add to.
Yeah, I bought the last 2 weeks. I'll buy some more as well. Just I had a lot of money come into the market, which is great timing. And I'm underallocated now to SoFi versus where I was before. I was pretty okay with what I had. I did, Steve, sell a whole bunch of cash secured puts for PayPal at 55 and SoFi at 650, figuring, I thought that SoFi would go down to $7.
Well, you make it assigned on SoFi, or you're not going to get assigned on PayPal.
I didn't. Well, I mean, it's already.
Oh, there for today.
Yeah,
Okay.
and I did. Well, so what I do when I sell covered calls or cash secured puts into earnings, it's very volatile, and if those ever go to, depending on the call or the put, $1 or $2, I'll just cover that. There's no
Hey,
reason.
good for your twin getting pissed off at me.
Dude, let's talk about PayPal.
Your twin got pissed off at me and said, "You know what, Steve? I want you to shut up, so I'm going to do more."
Your twin.
Dude, yes.
Yo, tell your freaking twin brother to like pump the stock a little bit more, man.
Let me.
No. Hold on. We're gonna talk about it in after hours. I'm sorry.
Okay.
Sell Palantir to buy SoFi. I might be selling PayPal to buy SoFi, and I'm not joking about that. That is a real development. We're gonna talk about it in the SoFi Weekly after hours. Everybody, thank you so much for joining. And admit it, this was a much more fun stream without Tanner. See you all later. Any last words from you, gentlemen?
Peace.
Steve?
Tavis.
All right. That's it.